All right, stocks started the day on a little bit of a down note, coming off of the election results from last night, which were pretty mixed and nothing too earth-shattering, nothing, definitely not market moving. But then, of course, we had the failure of FTX throughout the day, and the lack of a bailout from its competitor that sunk Bitcoin below very important technical support levels, pretty much bringing the rest of the broader market down along with it. Going into a really important CPI report tomorrow morning, the market's already been burned by trying to price in a dovish report, and maybe it's a little hesitant to try to price in another dovish report this go around. And so you put all those factors in the equation, you got some pretty decent moves. You got some really big moves in the dollar today and bonds, along with equities all across the board, from small caps to the Qs. All across the board, a weakness in equities. Disney, with its earnings, putting some pressure on the Dow. So we're going to break down the technical look at all of everything that's going on, what the technical environment looks like heading into this news report that literally could be anything. But of course, you took a look at the environment and what it's set up to do with tomorrow's result. And then we'll take a look at our trade idea of the day, and one of the sectors that actually outperformed. And we'll see if we can't take advantage of that outperformance with a bearish trade. We'll show you what I'm talking about there, and talk about that. So let's go ahead and get started. Today is Wednesday, November the 9th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon down there to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow us on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. If you're watching here on our blog, you can check out some of our classes over here on the right, including our Market Outlook live video I do at 3:30 Eastern time. We put on the trade before the market closes. Come down here to the bottom, click that heart. It opens up this tab. Hit that like button. Also that thumbs up icon. Click that like button again. The more you do that, it helps get our content out to all of our followers on those platforms. You can do it right now while you're watching. Let's see if we can't get back up to 100 there. Also, I want to give a shout out to Scott Wilson. Thank you very much for the super thanks. The way you can show your support with those super thanks is by clicking on that thanks button, clicking either one of these, hit buy a send. Just to kind of give you an idea, we do have our Black Friday sale coming up here, where we give our premium services for 20% off. So if you were to click on, let's say for an example, you were to click on the super thanks and put $3.25 in every time for every Market Outlook video going forward over the next 3 years. That's how much it would be for a premium. If you did that every day, that's how much it would be for a premium service. So in addition to all the videos that you get here, you also get all of that. All of our classes and all of our custom content, everything that goes with it, again, for 20% off of that. That's going to be our upcoming Black Friday sale around the Thanksgiving holiday. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you see that here, let's pull up the actual SPX on this. You can see that we had a little bit of a negative response to the midterm election results. Not that the results were anything dramatic per se, but it's about as gridlocked as it can be, especially when you consider both the House and the Senate. So the markets responded, and they responded quite a bit too, to a big breakdown in Bitcoin. Bitcoin finally busted through this important support level here, multiple Fibonacci lines, breaking down below 18,000. It tried to the day before, talks of a bailout that fell through today, and just a big breakdown that's going to lead us down potentially even further. So of course, that had an impact on risk appetite in general, and you can see the S&P fell because of it. Now it stayed above the moving average by about almost 0.5%. The intermediate line is still in bullish territory. It's falling, but it's in bullish territory. Market sentiment's rising, but it's in bearish territory. The momentum line fell to extreme lows. The near-term line fell, but fell out of bullish territory avoided being in bearish territory, though it would more than likely it's going to take a dramatic move to the upside tomorrow to avoid it continuing that decline. Remember, we already got a really significant bearish decline here. That's what that blue line represents. We already got a really significant bearish decline already on this drop. So to follow that up with another significant bearish decline, especially with a bearish near-term peak, would really put a damper on things, put some weight on the S&P. And again, if we go down to lower lows and break below this 3688 level, then we're on our move back down to retest those lows. And you can see the NASDAQ already has, right? The NASDAQ never did get above its, well, it did briefly, never did get above its 38% retracement, and it finally fell below, is well below that 23. So we are well into retesting lows. In fact, we're pretty close to the lowest close of the year. We'd have to get down to the low on the 13th to touch the intraday low point. You can see we're 3% below. On the other hand, the Dow Jones Industrial Average isn't even close to its 23% retracement. It's way up here, but it so far has failed to close above the 78% retracement of this run. And you see you got a downward trending resistance line for the Dow that we kind of had hit up against. So we were looking to get above that. We had a good close. It looks like it may end up being a fake out to close, because you're back below that 78% retracement of this current decline that we've been retracing, and you're back below the 50% mark of this big long-term decline that we've been retracing as well. So very important levels. Remember, the the S&P is pretty close to dropping below the 23. The NASDAQ already is below the 23. The 38 and 23% lines that are sitting here, actually this is the 38% line on black, and the 23% line on red. The Dow is way up above those lines. The S&P just barely broke down below them again, right? So there's those two lines on the Dow that were well up above. We're actually below it. So it kind of gives you an idea of where the Dow is and how much really the Dow has left to falter. The Russell 2000 actually looks very similar to the S&P. It's a little bit above the S&P, the 30-day moving average. The intermediate line's declining, market sentiment line's rising, momentum line down to extreme lows. Its near-term line avoided getting into bullish or the upper reversal zone, and now is down and is already down to lower lows, coming off of lower highs. So the Russell looks like it's on the way down. Of course, you got a big important CPI report tomorrow morning, but from a technical perspective, the markets look like they're on a new leg lower to the downside right now. Let's take a look at the long-term crossover chart. So you got the 10-40 week crossover. We had a couple weeks ago got a green arrow. Last week we got a red arrow with a lower close. This week so far another lower close. We still haven't reversed, right? You have to have a bearish candle that closes below this body, the body of the lower close, to reverse the bearishness. So we're not quite there yet, but you see how close we are, especially with the red arrow. PPO kind of where it's at. That's the PPO looks really low in comparison to recent levels, even the COVID low. But that's not very low compared to when we get into a bear market, right? When we get into a bear market, you're looking at a pretty sizable gap between the 10 and the 40 week moving averages. If I were to go all the way back to like that to 1958 here, you can see how we easily get the 10% mark in bear markets on all of these, including the 73, 74, and pretty close on the 69, 70 bear markets there. So 22, 23 is looking like it might end up being another one that we can add to the list of historical bear markets. Let's take a look at some of the oscillators. The RSI and the CCI, you can see, are breaking back into the lower half of the chart again after a brief move to the upside. The DMI for SPY, both of them between 25, so no real trend going, kind of setting up for a breakout. You can see that too on the Bollinger Bands. When you look at the Keltner channels, the bands are now back inside the Keltner channels. So we're back to a red dot back here not very long of a green dot, and so we'll see if we end up changing our direction. So you had green dots here, and then it turned red as we switched directions, and so that would be the expectation here. You got green dots, we've turned to red. Now you expect that we would switch directions there. Looking at the Ichimoku cloud, you can see how we're still holding the cloud for resistance as we move lower. And you also notice the 26-day return, where it's at here, it's actually negative now. So when you look at this rate of change here right here on the 26-day basis, this is the red line on the Ichimoku cloud plotted here. You can see it's gone negative. So now we're back to being at negative 1%. In other words, what that means is that the red line is below the price, and that kind of gives you an idea of where it has to, drop, how far it has to drop to stay negative. Obviously that kind of drop would keep us below the cloud and keep us below that blue line, and again, we don't have a trend going at all, so any kind of bullishness we had was not strong enough to establish a trend. Here's our Bollinger Bands again, right smack dab in the middle. So we're very neutral right now with a lot of this volume above us, not very much down below us. So we're setting up for some kind of move, especially with the volatility index starting to slowly work its way higher, and the volatility of the VIX really moving higher. So it jumped up in the last couple of days to pretty significant levels, up to 90. Remember, these two are correlated typically with each other. And you remember also that the VIX was negatively correlated with the S&P 500. So if I were to go on a 10-day basis, on a 2-week basis here, or positively, that's pretty rare for that to be positive. It's the first time all year it's been positive, and it typically leads to an increase in volatility, especially when you consider the volatility of the VIX was as low as it is. So we're kind of starting to set ourselves up for that. You can see the VIX here getting above its 8-day moving average today, exponential, and starting to work its way up above potentially the 17, getting back above the 217. Obviously, if we get a negative reaction in the markets to the CPI report tomorrow, it will probably, most likely, jump up to those levels. And we'll see how much, how far up it goes and how bearish we ultimately end up getting. We did get a lower high and a lower low. We closed below yesterday's low. We still don't have a bearish drop yet. But we are set up for one. The green's below 70, the red's hit 0, so we are set up for a bearish jump for the red line to hit 100. Of course, that would mean that we'd be hitting a new 4-week low point. And keep in mind that the low point right now is there and will be tomorrow, but after tomorrow it moves up, and then after that it moves up to here, right? It moves up into this level. So if I were to leave my cursor there, if you look over to the right, depending upon where we finish tomorrow, that's how close we would be to a new 4-week low point. In fact, we're probably closer now to a new 4-week low point after another couple of days than we would be to a new 4-week high point. And again, all depending upon how we respond. But not knowing what's going to happen tomorrow, just the event can be pretty random. But the technical environment heading into the event is setting up for weakness, right? Because that's what we have right now, where we are steering and moving in the direction of weakness here. You can see the daily hull, it's still negative. We still have the parabolic stars to the upside, and we had reversed this downward move with some bullishness. We've quickly reversed that back down, so we've got a lower close, and then we're trading right now at 374.13. So pretty likely that we'll end up closing below that body. Depending upon how much, again, if we rally, how much we rally tomorrow, post CPI. All right, now let's take a look at what's driving this price action. This is over the last 3 months. You can see the dollar and commodities have been the big story. Of course, they've been the big story, and yields. They've been the big story for all year long, much less the past 3 months. But let's look at just today alone. Again, a lot of it had to do with this Bitcoin news, putting pressure on IWM, QQQ. But what didn't get a lot of play today was that commodities really dropped pretty hard, down 2.25% today. The dollar was up almost 1% after a little bit of weakness early this morning. Gold took advantage of that weakness and then finished. But gold, even though the gold was down 0.5%, it still outpaced pretty much everything else except for bonds and the dollar. Outpaced all the equities, outpaced commodities, outpaced corporate bonds, real estate. So it's still up on the day, you could say, even though it was down on the absolute basis. You can see just everything was down. The international stocks outpacing U.S. stocks. Big moves. And if we take a look at that move in commodity prices, you'll see that, again, we're back down below the 17-day moving average, right? After being well above it, and then breaking back down the last 3 days. Big losing streak in 3 days. Big gap today. And we're not below the MACD's not below its moving average yet. Stochastics is. You can see the point of controls here. We get a big breakdown here that would reverse last week's move. Would pretty much start. I mean, we are back below the 17-week moving average. Week's not over, but a breakdown now. Again, to fill in this gap. We think that would be a bullish thing for equities, but the reality is it would reflect a pretty dramatic drop in risk appetite. Right now, we're kind of caught in between. We've talked about this before. The commodities catch-22, where if it rises, then inflation stays strong. But if it drops, it helps inflation ease, but it also means that we're in total demand destruction mode, which is recessionary. And that obviously leads to real bear markets, not these little fake ones that that everybody gets so worked up. All these corrections everybody gets so worked up about lately. So this would be a pretty dramatic drop. You can see the dollar tried to drop, but then today rallying back up, still below its 8-day moving average. This 23% line is a really important level, 29.5, because again, that starts the retracement. See, this is all noise until you break 23. Then that's when the retracement starts. If you take a look at Bitcoin, of course, that's the biggest mover of the day. Big dramatic drop. Let me show you where those lines are, where they're coming from. So the 0% line is the rally, the decline that we've been on all year, and then this green one was that last kind of significant drop. We've been sitting between 0 and 23 this whole time, really sitting on top of that 0% for this whole year's decline for pretty much months, multiple expiration cycles, and then this 78% line is coming off the COVID low point. So you can see the big break, dropping down towards this 10,000 area would get us down towards the September low, and just to kind of give you an idea of how correlated Bitcoin is with the S&P. There's been a few times this year or earlier this year, you can see there was a time where Bitcoin dropped pretty dramatically late last year into the beginning of this year, and the S&P stayed higher, and that's what brought the correlation down to negative levels. But for the most part, you can see it's pretty highly correlated with each other. If I were to use if I were to use ES over here instead of SPX, it would fill in that gap there. There we go. So you can see it's typically pretty darn correlated. Once we got to this low point on Bitcoin, you can see the S&P pretty much was at equal lows from where it was at here in September of last year. But by the time we got the market itself got down in March to its low point, it was lower lows along with Bitcoin. So you can see, even though Bitcoin dropped initially and the market stayed bullish, the S&P eventually caught up to it and also ended up at lower lows. Then we had the rally, right? They both rallied there. We got back to positive correlations. And then you can see that Bitcoin dropped again pretty dramatically. And the S&P kind of did, but it wasn't as bad as what we had seen. You can see, that Bitcoin was down. The S&P was kind of sitting at relatively low levels too, and then you can see like the S&P eventually came back down and dropped to these lower low points, and basically caught down to what what Bitcoin had dropped down to, and then now here we are breaking below an important level, and you would expect the S&P to break it too. Remember, the Nasdaq's actually pretty close to it. And then again, if we're going to look at this 10,000 level, which is the right in here, this September 2020, that essentially gets us down to 3,200, which is a level we've been talking about for a while, kind of on the S&P of where it could drop before it made, to get below the 200-week moving average, before it finally hit some support. So you can see that's where these Fibonacci lines are. So 3,200 is a really pretty obvious level. A lot of people have been talking about that, but that's the reason from a Fibonacci standpoint. And then we could start looking for the return move, right? The move back up, probably up towards 3,500 by then, if not a little bit higher, before it rolls over and we really start into full-on 2023 bear market mode is my expectation. And you can see that Bitcoin has led the market down twice this year, and it appears to be doing it again. And it'll just be a matter of time when the S&P catches down to where Bitcoin is, like it did, the other couple of times that you had pretty big dramatic moves on Bitcoin before the S&P finally followed suit. Let's take a look now at the sector moves. The comparison chart here, and you can see energy just really killing it over the last 3 months, but not necessarily killing it today. You can see the biggest losers today was energy, but also technology and discretionary. So again, between communication services and these other two sectors making up, around 40% of the total S&P 500, you don't really want them to be your market leadership on the downside, and that's been the case here for the last few days. In fact, if I were to zoom out and look at the last couple of days sessions here, going all the way to Monday, we started off pretty strong, but then from Tuesday's peak, really earlier, we've been declining. Technology was a big winner early this week along with materials. Technology now is pulling back, and discretionary is just getting hammered. Utilities started the week down, and you saw today, utilities was your best performer today, holding up the best along with staples and healthcare and real estate areas, typical areas of the market that you would expect would lose less than what the broad market would lose as a whole, and other areas of the market would lose even more than that. All right, today's trade idea, speaking of consumer staples, is on Colgate-Palmolive. You can see, if you take a look at it, obviously it looks bullish here, dark green shading and a green line. You can see we're kind of hitting up against a 38% retracement of this decline that we've had. But you also see, if I were to keep my cursor here, follow it along to the left, there's multiple touches at this point. There's another reason why it's stalling in this area with a bearish near-term peak that's already out of bullish territory. That would be a slightly lower low. We are heading up against some resistance. If you look at its weekly chart, it has a lower close in the week, kind of slightly lower close in the week there. Obviously, no close. We never did get a close above any of these highs, which is what you like to see for a really good, strong reversal pattern, just like you'd like to see a close below these lows, like you actually did right there. You got a close below those lows. You did not get a close once we got the reversal above these highs, because that high was so big up there. So it's kind of hard to maintain that, as you've seen. The stock itself has 3 green arrows right now as the stochastics is turned up. But when you look at these lines, the stock is sitting above its 30-day moving average, but right at the 50. In fact, it's been holding the 50 with this big doji pattern yesterday for some time. And if you look at the stochastic, or the MACD, zoom in on the MACD here, you can see that it's been below its moving average while the stock itself is above its 17-day moving average. So in other words, we're in convergence mode. We've been in this bullish mode, but now we're stalling as the MACD can't get above its moving average. Not a surprise that we're also got a lot of volume up above here. In fact, 70% of the entire year's worth of volume is above this resistance. So pretty strong resistance in this area. You can see how you're not getting any, like the RSI can't get above 60, the CCI can't get above 100. When you look at the DMI here, you can see that, again, like the S&P, they're kind of both this flat and sideways, kind of looking for a breakout pattern to develop. When you look at its Bollinger Bands with its Keltner channels, have come well inside of its Keltner channels as the bandwidth is getting down to a low level. So again, you're setting yourself up for a move in either direction. The issue with the cloud above us, you would expect that direction would be to the downside. You have a pretty strong positive rate of change, but it looks like, again, you're probably on course to kind of cross back through price in the next week or so. So what I decided to do as a result is to say, okay, well, let's take a look at its options chain and let's sell a bear call spread. I've got about 17 days left. I can try to get a 50% return on this really quickly because they tend to happen like that on the bear calls. So sell the 75, buy the 77.5. Here, let's go to a single symbol. You can see, we put this trade on during the Market Outlook Live, and it's still pretty much in the same spot as it was in when we got into it. And so as long as it stays, their break even's right up there. As long as we hold this resistance and drop, we're fine. If we go up, we've got a little bit of wiggle room between the 38 and 50 that we can still hold some resistance area in here. Breaking above the 50, then we'll see what kind of trend it takes at that point. But probably wouldn't want to be in it any longer. And that's when we would, at most, be willing to lose $450 since that's what we're trying to make on this credit spread. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video down below. Subscribe to our website at marketscholars.com for free. Follow us on Twitter or like us on Twitter. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.